Hello and welcome to the special edition of Mutual Fund Corner YouTube edition. Thank you so much for tuning in as always. Now today what we're going to be discussing is going to be mistakes that you should avoid as an investor while investing in mutual funds. It's very important, right? Because there is so many options, there are so many things to review. Which are these mistakes that you can avoid? That's what we'll be discussing. And to discuss just that, we have Mr. Bibhuti Bhusan Dash, who's the founder and director at Lotusmint Wealth Private Limited. Thank you so much, sir, for joining us on this special edition of Mutual Fund Corner. Let's start by talking about what are the most basic mistakes as an investor that you have seen that people make while investing in mutual funds, and that is something that they can avoid.
Yes, Vinny, this is a very common question for all the people, and we have questioned ourselves in many times. What is the common mistake? The first most common mistake is not to invest early. That is the most important mistake everybody does, because you do not invest early, then you lose the compounding impact. Then the most important other things, like you are not investing with a specific financial goals unless until you are having certain goals, and these goals are associated with some kind of investment, then you do not able to get the right kind of investment strategy. Then sometimes most of the people are chasing certain performing funds, which is not good in the sense, without understanding the risk of the fund you are chasing. Funds means you have to lose, or you may drag yourself into problem. Most of the people, they do not allocate their assets in the right way. It means, what I wanted to say, somebody is more aligned to property, somebody is more aligned to equity, somebody is more aligned to fixed deposit type of things. It means you should have the balanced type of investment in different asset class. And very common, which most of the people do, when the market goes down, they come out from the investment without means waiting for certain period of the bad period which cracks the market. So that is also very wrong thing. And most of the people in my country, they do mix insurance with the investment. Insurance generally is a risk management tool, but most of the people, they do consider insurance as an investment. And last not the least, not reviewing the portfolio very consistently. It means whenever you are investing something, reviewing your portfolio at least quarterly or half-yearly is required. So in my opinion, these are the major mistakes which common man does. If somebody can control these things, then the wealth creation will be in the right track.
Absolutely, these are the mistakes that one could avoid. Sir, but there's one thing that I want to understand, right? Because normally for an investor who's just starting off, usually the understanding is that mutual fund is going to be tracking the underlying assets, right? Whether it's equity, debt, gold, a mix of all of this. But is that enough, or is there more that one should look into?
Just look into the mutual fund, debt, equity, or might be gold, or might be REIT. These are the common baseline. But at the same time, when you are investing, you should know who is the fund manager, what is his strategy, what is his consistency, how old the fund is. And in most of the case, you have to also understand whether it is value-oriented fund or growth-oriented fund, or it is a passive or active fund. So these are the things you need to understand. And at the same time, you have to also understand what is the cost ratio, means what is the cost you are paying for the buying that particular mutual fund scheme. So these are the main things, and no doubt tax liability is also very much important. In case of equity, there is a different tax law. In case of debt, there is a different asset class tax application. So you have to understand the tax liability of the things. Other than that, also, when you are allocating your asset, you have to understand what is the real asset allocation and what is the goal you are going to achieve.
Absolutely. Goals, asset allocation, all that becomes very important. But sir, sometimes, we have that available option to easily check past returns. Are past returns actually enough to decide whether I should invest in a mutual fund? What's your thought on that?
It's a common again mistake by all the people. We do consider the past return में क्या है आगे मेरे को वही मिलेगा. But that is not the case. You have to understand what is the fundamental of the scheme. In the sense, what is its Sharpe ratio, what is the standard deviation, what kind of a drawdown approach that scheme is having, what is the consistency this fund is having in different market cycle. And other than that, also you have to see whether the fund is related to specific sectors or having any kind of credit risk in case of debt fund. These are all things you need to understand when you are putting in the investment. Only don't see the past record. Past record might be one of the parameter, but it will not hold good in future. In my opinion, every investment, again, I mean to say, you have to don't chase the return. Please don't ignore the risk, and don't stop the SIPs when market fall, and stay goal focused and disciplined approach of investment.
Absolutely. So you touched upon risk. That's my next question, because I want to understand what is the risk profile that one should see while investing. And, because different categories will have different risk profiles. How should one go about that to avoid any mistakes?
Naturally, we have to divide the asset class into two categories. One is equity, another is non-equity. In case of equity, everybody should know it is attached to some kind of risk. It might be market risk, it might be sectoral risk, it might be geopolitical risk, all these things. Whereas in case of real estate, or in case of fixed deposit, or in case of gold, the risk is comparatively less than the equity class of assets. So when the investor invests in certain goal-oriented thought process, then he has to see if there is a long time on the horizon is there for the investment and wealth creation. He can very well go for equity, because in long run, equity, even if it is associated with a risk, it will give you a decent return. In case of short term or in the medium term, you can think about the debt-oriented fund or FDs-oriented fund, even if you can think about gold. But in the same time, when a person is having the mixed thought process, means a medium core of risk thought process, then he can think about hybrid, the combination both equity and the debt funds.
Okay. And so what about, particular date for SIP? A lot of investors ask, is this the right date? Should I go on 1st? Should I go on 5th? Should I start my SIP on 10th? Is that the right way to look at it, or just start an SIP?
It is completely not related to any specific date for the SIP investment. We have seen in a lot of statistical report, there is no specific date which will give you a better return as far as SIPs are concerned. The most important thing for SIP, you continue with the SIP, you be disciplined, you don't forget to pay the every month installment, you can say, the amount you are contributing for the SIP. So in my opinion, all the SIPs should continue for a longer term period and with the goal-based thought process. So that will give you a very proper kind of return.
Absolutely, Mr. Bibhuti. But, thank you so much for joining us today, giving the viewers that insight of what they should avoid, how they can go about it, what are the myths while investing in mutual fund also, which actually become mistakes, is what one could look at avoiding. Thank you so much for joining us on MF Corner.
Thank you. Thank you.